Good morning. My name is Adisha Nadu, and I'm from the Global Markets Retail Investment Team. I'm joined once again with Tom Gale, Executive Trading Global Markets Standard Bank. This is the Market Pulse. Good morning, Tom.
Hello, Eddie.
Tom, we spoke last week, Wednesday. MTBPS was the topic of the day. As we know, we waited for our pulse. We did know that we said and alluded to the fact that Friday there was a ratings possibly upgrade, which we see happened. We see gold. We see gold that's obviously trading and trailing beyond its highs. We're seeing the rand at strongest levels against the dollar. There's so much going on, and we actually have a Cell C IPO up and coming. So hopefully you can take away all this noise and just give our audience something to focus on because there's a lot going on, Tom.
Yes, story of the year, isn't it, Eddie? Lots going on, lots to get our heads around. As you rightly say, we did cover some of this in the post medium-term budget session of the Pulse that we had last week on Wednesday. So I'll try not to go over old ground. Let's start by setting the scene globally. I think the big development which was starting to take shape last week was that the US government was getting set to reopen. And that was initially embraced by markets as good news. But I think there are lingering effects of this, and we'll come on to some of those points in a moment. The about turn in risk assets, US risk assets. I mean, when we talk about risk assets, it's a broad generic term. It can mean many things. And in this particular case, I'm showing a chart of percentage gains and losses for this year for the S&P, Nvidia, Oracle, and Bitcoin. Really just to show that we've blown off a bit of the froth in the excitement that we'd had in September. And in fact, the most pertinent of the lines here on the chart is the purple line. That one is Oracle. And Oracle caused a stir in September when it announced big investment into AI. And the market back then rewarded it for such a commitment. But as you can see from that line, the market then had another rethink, and since then the stock Oracle has lost all those September gains and has given back even more. It's not dissimilar, the shape of the chart for Nvidia, which by the way has earnings coming this week on Wednesday, very late in the evening on Wednesday. And those of you, Adi, and your audience who trade Bitcoin will know it's been a rough ride for Bitcoin recently. It dropped below $100,000 on Friday. The S&P, the white line, has actually been fairly steady all year, and that's partly because a lot of the S&P just hasn't had a very good year, and some of the S&Ps had a great year. You know, those some of those stocks that I've been mentioning. So you're much more diversified in the S&P, of course.
Well, the beauty of all of that, Tom, is exactly that. And you're 100% right. I think the Bitcoin erased majority of its gains this year. And the beauty is those instruments are tradable on our platforms. And I mean, we have the Bitcoin ETF. So if you were invested in that in WebTrader, it kind of, as I said, gave away a lot of its gains. Nvidia, Oracle as well, US stocks that we have available, as well as CFDs on WebTrader. So if you're trading these instruments, brilliant. I mean, CFDs are there for exactly that purpose. If you're actually holding the stock, it could have been a bit of a hard pill to swallow considering the sell off. But I mean, what are you seeing from this, Tom? Is there more opportunity here? Is this a buy or a sell? Just out of interest.
Okay. What's the beef? Indeed, I don't pretend to have all the answers, Adi. So, if I had the answers, as we've said before, we wouldn't be sitting here in the office.
We'd be chilling on a beach somewhere. But you've called them right. You have called quite a few of them right.
So, some good, some not so good. But let's not dwell. I think, as is often the case, the least risky way to play some of these themes is as a basket or an auto call. And I think if you're still deciding on the AI auto call, the product that we're going to close
3rd of December, correct.
3rd of December.
We've got the AI China Tech auto call. That's best of both. It's as I said, we've covered it on so many pulses before, but you're 100% correct and spot on with the memory. Closing on the 3rd of December, so still a few weeks to invest in that in online share trading, ASI as well, and through a broker. But yeah, that's still ongoing.
Okay, so that remains a sensible way to play the theme. If you're picking a specific stock, then I think it's over to you and your audience to decide the best way to identify the dips and the peaks and so on. But certainly I can give some context around why some of the sentiment is souring. And as I alluded to earlier, the US government shutdown did a couple of things. The first thing it did was it just left a vacuum of data. So the departments of statistics that collect and then publish a lot of the data were not being funded through shutdown, and so stopped producing data, and that's clouded the outlook for many observers, including the Fed, the Federal Reserve. And so the Federal Reserve now has been unable to see clearly whether another cut in December is justified or not. And the other impact of the government shutdown has been, as I say, that those recipients of federal wages and so on have not been getting their pay packet, and that's really tightened the screws on a section of the US consumer, US individuals who were already struggling with cost of living. We sometimes talk about a K-shaped economy in the US, and if you picture the top of the K being showing a bounce, that would allude to the AI piece of the economy, but the bottom of the K is the mirror opposite, and that is the lower income groups who are struggling. And in fact, so much so that there's been talk of $2,000 checks going to a large number of the population. That is certainly not close to being policy. It would need congressional approval. We know what happened last time that that was done in COVID and led to a stock market rally, but we're not close to that yet. But the other thing that Trump, whose ratings have plummeted recently, is having to deal with is indeed the cost of living. And with that in mind, Trump has moved to reduce the cost of agricultural imports to the US by walking back on tariffs. So just to summarize there, we've got fewer rate cuts as the Fed would have it right now in the US. That has led to a bit of the shine coming off Bitcoin and the AI sectors, and equally. There's a political temperature being taken in the States, which, as we all know from the election of the far left candidate to New York mayor, Zoran Mamdani, it's a large portion of the US economy is really struggling. US food prices have continued higher. If you look at the graphic on the right, US inflation by product type, you might see at the bottom in orange that eggs have come lower, and that was one of the crucial components of the election last year in the States, because egg prices had rallied so sharply. Trump has had some success in bringing down eggs prices, but look at the rest of the graphic. Beef prices are up enormously in the States this year, and as you and I well know, Adi, Americans eat a lot of beef.
Yeah. So that's a bit of a hard pill for them to swallow.
That's it. And just broadly, as you can see from the graphic, lots of components adding to the higher cost of living in the States.
Quite an interesting one there, Tom, is home insurance.
Yes, well, don't test me on too many of these, sectors, but it's quite possible. There's a number of factors at play there, not least climate change, levels of crime, and so on. But I don't think this is the forum to dwell on that particular item just yet. I do want to just zoom in on this executive order, though, that Trump signed on Friday, because it does remove entirely all import tariffs on certain agricultural products, coffee and tea, fruits, tropical fruits, cocoas, bananas, oranges, tomatoes, and beef. And I think this is important for us here in South Africa because, as you well know, we do export a number of these items to the US. They were being hit then with 30% tariffs, no longer. So those will be excluded with immediate effect.
Oh wow, okay. I was just about to ask, when is that going to actually trickle on? Because I mean, we remember the tariff conversation, which caused a stir in equity markets and across all markets. I mean, I'm just quite. Would we see this kind of similar, or I mean, how do we see this play out now?
Well, we'll come on to some of that and my thoughts on that in just a moment. I do think that as we sort of just close out on the US item, let's just talk finally. There is an economic impact. We always knew that the US, there was a good chance the US would be in recession this year, were it not for AI and the impact of big capital spend by a large proportion of the S&P. Well, it would seem at the moment that coming to bear is now some of the downward pressure on the US economy, having been exacerbated by the government shutdown. And our G10 currency strategist, Steve Barrow, he notes that the dollar resumes a drift lower, and he has become quite bearish again on the dollar in the short term for the time being. So he's got short positions on the dollar against euro, against yen, against sterling, and against Swissy, amongst others.
Okay.
We're coming on to what affects South Africa. We've talked about Bitcoin and why Bitcoin has been selling off. There's obviously been some margin calls there, I suspect, but what triggered the selling? Well, as I say, that was the market starting to price out the prospect of aggressive rate cuts in the States. And some of that also applies to gold. As Bitcoin fell through $100,000, so too did gold pull back. But we're not too concerned. I think we've talked about this in the past, Adi, that our analysts remain very constructive on gold. And platinum, and you'll recall some of the levels, but the point here is, as we've said before, we prefer not to short sell any of the moves in precious, rather use the dips to buy. And once again, you can access some of that product, some of Standard Bank's ETF product on the JSE, ETF GLD for gold and ETF PLT for platinum.
Yeah, those are on online share trading and auto share invest, as well as Shift as well. So yeah.
Okay, good. Right. The pullback in gold has created a bit of a headwind from terms of trade. In other words, if gold comes lower, that means marginally less export receipts for gold and platinum. I've inverted the blue line here, which is dollar rand. So the higher it goes, the stronger it's getting. But the white line, South African terms of trade, is just struggling to make fresh headway. We are not too concerned, Adi. We're not too concerned because the SA story has become much more than just about gold and platinum. And we talked about agricultural product a moment ago. It's not enormous. It doesn't change the game on its own, but it is a positive, especially if you're a farmer exporting fruit to the US. But actually, more broadly speaking, reform is starting to get behind the South African story. And we've seen that. We've had that vindicated in a ratings upgrade.
Okay.
So our credit rating late on Friday was upgraded by S&P, one of the three major ratings agencies, one notch, and it was one notch to foreign currency rating and one notch to its local currency rating. And what does all that mean? Well, let me just caution. Well, of course,
it just looks like BB and BB plus, and I mean, I'm sure for a lot of the audience, they just try to make sense of that. So.
Well, think of your school grades, Addy.
Exactly.
These are not A's, I'm afraid. But
We'll get there eventually.
we'll get there, as you say. We all South Africa is still sitting in junk. All three major agencies still have South Africa as junk rated. That is to say, not investment grade. So very speculative if you're lending your money to the government. But the important point here is the direction of travel, and I think the first ratings downgrades started in 2017, not long after the second term of Jacob Zuma. We've been on some sort of reform drive since then, under Cyril Ramaphosa, and more recently under the GNU. So the direction of travel is what's important, and I would actually point out what is actually impressive from Friday's S&P move was not only that they upgraded, but also they left the outlook as positive. And typically, if the outlook is positive, it'll need addressing within the next 12 months. In other words, they would either have to lower the outlook or they would have to deliver another upgrade.
Oh, wow. Okay.
So we're in a better place with our fiscus than we were back then, or at least the direction of travel is much improved. We talked last Wednesday about Elna's thoughts on the MTBPS. Elna Moorman, you'll recall, is our South African economist, and she was largely constructive on the outcome of the budget, as were a lot of SA assets. And you and I were debating as to whether we would keep this slide in, and it's stayed in. I think the important point here is that the cost of borrowing for the South African government has continued to fall, and it's continued to fall post the budget.
Okay.
So investors are saying that just like S&P, we are far less uninvestable. If you like, we're more investable. And so if you buy our bonds, that helps bring yields lower, which is effectively the cost of government borrowing. And this is important as well because the more that our bonds rally and the yields drop, the more that is positive for South African equities.
Okay.
Now, I don't know if you recall, 2 or 3 pulses ago, we did talk through this briefly. Our equity strategist, Deanne Gordon, was comparing the big bond rally that South Africa's had this year with equities, which large sectors of have lagged, and so were due some sort of catch up. Well, the point here, simply, Addy, is that yes, bonds have continued to rally, yields have continued to fall. That makes the cost of borrowing much cheaper, not just for the government, but for corporates as well, eventually. And the the implications for this are far and wide. And so we can consider this a vote of confidence for our equities as well as bonds.
Well, that's an interesting way to look at it, because, as I said, we don't have the ability for our retail clients at the moment to trade bonds, but the correlation and how it affects equity markets is certainly appreciated. I mean, it's a nice way to obviously sum it up.
Yes, indeed. We don't need to go into the details, as you say, not always tradable. By the way, there is an ETF that we have listed again on the JSE, and you'll find it. It's ETF BND, Bravo November Delta, and that's one way to play bonds through a listed equity. But we've certainly done a lot this year. We can probably do a bit more, but as it were, the easy money's been made. I think that there's good prospects for our equities, particularly the consumer equities. But we would certainly need a trigger, and one of the triggers might be this week, Addy, because we are due to hear from our Reserve Bank on Thursday, and the question is going to be, where are our rate cuts? Well, we're expecting one this week. We're expecting one, and given how our inflation and inflation expectations, the orange and blue lines on the chart here, have been so low, well, we should be cutting rates, the white line, and expectations of cuts in purple. Those two lines at the top should be coming a lot lower if inflation is the only thing that's important here.
Well, to that point, I mean, you say we are expecting a rate cut. If memory serves me correct, usually when the US cuts rates, we have a meeting quite soon after, and obviously we have to actually follow suit. But I mean, the US has cut 50 basis points in this time, and if I'm not mistaken, the last time our governors decided to keep rates constant. So I mean, as in no cut. So is there a possibility that we have a bigger cut, or is this? I mean, is it? I mean, I see here already on the slide you've got 95% priced in of a 25 basis point cut, 50 off the cards.
Yeah, I mean, you make a couple of interesting points there, Adi. The first thing to say is that, well, 50 basis points is never off the cards, but I think it's highly unlikely.
Okay.
And I'll come on to that in just a moment. You also made a point about the rate cuts for South Africa, which you can see on the white line on the left. So we've come down from a peak, a repo rate just above 8% to the current 7%. Rates in the US have come down from just above 5% to just below 4%. So we haven't lagged significantly. The other thing to say is that we never move lockstep with the US. We don't, because we've got many more uncertainties. We're a much smaller economy. And so we have to build in a bit of fat, especially to allow for positive capital flows. But as much as this week's meeting is priced, as you say, we paused last time around when we figured we might have got it last time. We'll get this one because we still have a high real rate. That is to say, our rates are much higher than inflation, as I alluded to in the previous slide. And so they do have a bit of room to cut. So we'll get this cut. But if now the Reserve Bank and National Treasury are determined to anchor inflation expectations at 3%, previously it was a band of 3 to 6, it's now 3%. Well, they may need to just keep rates slightly higher for slightly longer, just to help demonstrate the commitment to that. Okay. I do just want to mention in passing that South African inflation has been improving versus the US. In fact, this is a chart which might surprise some of your audience, because the line in blue is US inflation, and you can see actually US inflation peaked way above South Africa inflation post-COVID. The blue line was higher, and so in recent years you can see that the two measures of headline inflation, South Africa and US, have more or less converged. Pretty good. We're sitting just above the US measure right now, but it's not bad, right? But I think, again, although we should be recognized and complimented for this, and eventually it would allow for more rate cuts, better behaved inflation and ingrained and entrenched inflation being much lower would allow for more rate cuts. For the time being, the Reserve Bank and National Treasury will need to drive home the message that that inflation is going to be anchored lower. Okay, with the rate cut due this week, and with a very good MT BPS last week, there has been a few signs of fresh legs for SA Inc. So let's think of retailers and banks for now. They performed a bit better in the last few days. And yes, that'll be partly the rate cut that's coming. It'll be partly the good news in the statement last week, but it's also a little bit to do with something we've talked about in a previous pulse, which is the foreign underweight in the South African market. And our strategist, who I spoke about earlier, Deanne Gordon, she's making the point that a lot of the foreigners do not have enough South African equities, and they're sitting underweight, as you'll see from chart 3 on the right there, sitting with a big underweight for South Africa, when South Africa is now one of the most important country weights in the foreign benchmark in this time zone. And top left, chart number 1, in red, the South African stock market has been outperforming other emerging market peers. And chart 2, bottom left, in red, our valuations are still cheap compared to the rest of emerging markets. So there's a very convincing case for foreigners to buy some of our stocks. Where would they Where would they buy? Well, typically they'd come for retailers and banks, and actually we've seen that in the last few days. We have seen a bit of buying. It's not a game changer yet, but we've seen it in a couple of the banks and a couple of the retailers. The last thing I want to talk about today is something that's received a lot of publicity in the press in the last few weeks and months, and we have spoken to it a little bit internally at Standard Bank and in some of our research reports. The latest one is from Eleanor Moolman, our economist, this morning, and it's talking to the state of the state of the South African consumer, and the retailers are struggling up against the challenge of drawing consumers' money away from gambling. Gambling has really been the bogeyman in the room. Some of the gambling stocks here on the JSE have done quite well. I think of Sun International, for example, that owns Sunbets and so on, has done very well from online gambling. Since COVID, South Africans are spending more and more of their disposable income on gambling, and that,
is this
of
gambling
course,
online or gambling in total?
Yes, well, it will be mostly online because that's the easiest way to access it now. But sure, if you can walk into a betting shop or a casino, that's included. But it's the online gambling that's done very well, and you find it difficult to turn a corner or turn on the TV without seeing some celebrity endorse the latest online gambling
or sports
website.
team wearing it, or sports team wearing it for that fact.
Yes, indeed. Well, it's become a little corrosive, I would say, morally speaking, in the sense that the house is going to always win. So broadly speaking, that's money that a South African consumer will spend but not see a tangible benefit for. And a lot of the CEOs of the retailers have been complaining in recent weeks about the impact of gambling. Eleanor Moolman does talk to it in her latest report. She does actually argue that it's modest for most people, but of course it can be more chronic for sort of some portions of society. With that in mind, there may well be some regulation coming next year to clamp down on online gambling's ability to advertise, perhaps to whom they advertise, perhaps who is able and allowed by law to gamble, and so on. So there may be some regulation coming which could, and I stress could, help lift some of the consumer stocks. That could be another catalyst into the new year. So that's a topic that we'll be following closely.
Oh, thanks, Tom. I mean, it's quite an interesting one. I mean, if I'm not mistaken, those stats are quite surprising considering the ease in which you can actually get onto these gambling websites. So it's an interesting topic that we'll follow closely. But it's been a lot, and as I said, a lot we've covered today. Hopefully, it gives our audience some sense and some direction on how to kind of gauge this week. But we'll keep a close eye on the rate cut coming, and we'll chat again next week. As always, thank you so much for all your insights.
Thank you, Adi.